I'm joined here today by Olivia Thoral, AXA Real Estate, Dan Fasulo from Real Capital Analytics, and Jeff Lafleur from WP Carey. Gentlemen, thank you all so much for joining me today.
Thank you.
Thank you.
Demand for European real estate opportunities seems to be outpacing other regions globally at the moment. You just look at the top 4 destinations for cross-border capital, UK and France, are very firmly placed within that. Olivia, if I can open up with you, obviously we've talked about AXA being a significant seller in 2013. I know Europe was one of the prime areas. Can you just tell me, where you found some of the best opportunities to sell?
We sold over 3 billion euros worth of real estate, and that was primarily in Europe. But we have also invested nearly 3 billion, and the vast majority was also in Europe. We have made some investments in Asia and the US. But as a whole, you're right, we've been also selling actively, and we continue to sell actively, but we are not just a net seller. We think that core properties in some private markets are trading at extremely high level, and we see a great opportunity to sell some of those properties. What we have also been seeing in 2013 is much more liquidity, much more appetite for certain of the Southern European countries where there were virtually no market during the Euro crisis. In the course of 2013, investors have come back with a greater risk appetite for those countries, or they have a perception that the risk level has decreased, and therefore there is much more capital, and we've been extremely successful at selling portfolios or single properties in Spain and in Italy. We are also selling in Paris. We are trading assets in the various markets in Germany. But I think as a whole, core properties and also Southern Europe, where liquidity is back.
So Jeff, I want to bring in some of the comments obviously that Olivier made. Obviously, he's talking about obviously the opportunity to sell, particularly in the peripheral markets as well as obviously the prime markets. What are you seeing on the ground? Where are you seeing some of the best opportunities as kind of a buyer?
I think it's a mix of both. I think, as he mentioned, liquidity is a big factor right now. And so while cap rates are very low in core, and it's a great time to be selling core assets, the financing we can get in buying core assets is what we haven't seen this in so many years. I mean, we're back to 07 levels of, well, not close, but we're nearly at 07 levels of margin, of LTV, really a lot of enthusiasm for lenders to finance these properties. So I think as a buyer of core assets, we can get great financing. The secondary markets are still out of favor. They're not really on lenders' target list of where they want to be doing loans right now. But then again, the yield for secondary markets is still there. I think if you're looking for yield and you have a big balance sheet and you can put down big equity, you can get pretty good premiums to what you're seeing in the core markets. So I think it's really a balance of those two, and obviously not getting stuck paying too low of a yield on core, and also not getting stuck with too much leasing or back-end risk on buying secondary. And so it's, finding that balance is really a thing to do right now.
I know there was one statistic that I recently read in terms of yield compression between the primary and the prime markets and the peripheral markets, particularly for office. They'd compressed 80 basis points in the past year. What are you seeing in terms of kind of yield compression between that primary and that peripheral market in Europe?
Well, if we go back to 2011 or even early 12, that wide spread had opened up between kind of core London, Paris, and then secondary, the periphery of Europe. And it's drawn a massive amount of interest and capital to those regions. And not coincidentally, in our statistics, when you look at the big year-over-year jumps in transaction activity in Europe, it was Ireland and Spain and Italy. The markets that fell out of favor.
Where are you seeing most activity and most transactions?
Yeah, I mean, it's the dominant kind of gateway cities is where, if you're looking by the actual value of the transactions, the Londons, the Paris, some of the German centers. But if you look around with some of these big portfolios starting to take place, in Ireland and Spain, Blackstone took down $1 billion portfolio just a couple of weeks ago in Ireland. The numbers start to add up pretty quickly on the continent.
And what's your expectations as you look out in 2014? Where do you expect to see the greatest increase?
There's a couple of wild cards out there, right? I wouldn't bet on Eastern Europe right now. for obvious reasons. It is, at some point, discretionary selling is also going to influence how many transactions happen. And, Olivia's, try getting someone to sell an asset in Paris. It's not easy. You don't want to do it unless, pricing is at kind of a historically attractive level. But I do see continued momentum, just given the weight of capital that's running around. We've heard about a lot of new Asian investors running around Europe right now.
I've heard rumors of Asian investors showing more interest. And of course, Middle Eastern investors have always been kind of in the rafters, picking out trophy assets and taking down things like that. But those tend to be really ultra core, central London, CBD Paris, with a complete disregard for the rest of the market. So I don't really know if you can call them competitors. But the same names we've seen before, AXA and DECA and London and Regional, these are big guys that have been around for a while. They know what they're doing. They can show flexibility in different markets. But no one's really popped up as a true new face that can prove themselves to be a real reliable buyer. And when you're talking about big trophy deals, large transactions, you don't want to do the first deal with the first new investor and have it be that big deal. So I think there's a hesitation to get stuck with kind of a deal blowing up on you and working with an unknown name. Everyone would rather do a deal, with AXA, buying or selling, or with London Regional, or with DECA, names that people recognize. So, I'd love to know who the new Asian investors are and identify them and figure out what they're trying to do. But as of yet, I've yet to see them make a real impression on European deals.
And Olivia, I want to bring you in just in terms of what you saw in terms of who were some of the buyers, particularly for the AXA deals, but what you're generally seeing on the ground.
Where we have seen new capital, or more recently capital, in this cycle are a number of the large opportunistic funds. They are strongly back and they are really looking at Southern Europe. It started maybe a year ago. And it has been an increased interest over the last 12, 18 months. We are seeing also some new sovereign funds from Central Asia or East Asia or Northern Asian, or some Northern Asian insurance companies from Korea, for example. They are investing in Europe. And in some cases, we are teaming up or partnering with them. So it's also an opportunity to work with those new sources of capital and to give them access to deals and provide thereafter also asset management services. But I would say there are a lot of capital now, both European, some of the German funds continue to collect money. A number of them are liquidating and are putting assets on the market, but some of them remain active. So there are the classic investors and some new ones.
I was actually going to ask about kind of the activity of the German open-ended funds. Dan and Jeff, have you seen much activity from that front, from the German open-endeds?
Yeah, I think every once in a while you'll see a transaction pop up, a secondary transaction with an existing lease, and you'll wonder where it came from and why it's being sold. And there's been a few occasions where it's been a German fund that has a liquidation issue going on, and that really didn't occur pre-crisis. Really, the crisis definitely pulled down a bunch of German funds, forced liquidations based on the way they're structured in Germany. And a few more of those have been popping up, I think, over the last 12 months, and maybe over the next year or so, we'll see more of that come to the market.
They've definitely been net sellers recently, and I think they will continue to be net sellers in 2014. Some of the other sellers we're seeing are certainly the governments to the non-performing loan portfolios, a lot of the banks.
And I did want to bring that up in terms of obviously the banks. That's obviously been a big story in terms of the activity in Europe, both on a buying opportunity and obviously them selling. Whether it's asset sales, perhaps sale leasebacks, and non-performing loans. Dan, just give me an overview as to kind of how active are the banks in terms of getting rid of some of their, their legacy assets and their portfolios?
Well, they're never going to move fast enough for the U.S. opportunity funds that want to buy these assets. The U.S. is in the later innings of working itself through the distress cycle. I would say Europe's probably in the earlier innings. Certain countries may be ahead of others, but it's been slow going. And to date, it's been a winning strategy, right? As values have kind of recovered little by little, and liquidity has come back, and pricing is some are even exiting some of this stuff at a gain, right? That was unimaginable a couple of years ago.
I think it's a mistake to think of the banks as being in jeopardy or is needing to do fire sales. I think there was a brief time period in 2009, 2010, when certainly some banks were going under, and there were issues in the banking sector that people were saying, oh, it's huge opportunities to buy these assets. But the banks have gotten tremendous support from their governments, and they've shown an ability, as he said, to ride out the pricing and to not have to sell at fire sale values. And so they have implicit support from their governments, they have direct support from their governments, they've managed to ride out where they are and not have to have these huge portfolios just be sold at incredible discounts. So the opportunity, I think, for doing bank deals, I think there was an opportunity there. I think now a bank will not come to the market with a huge transaction and say we're going to sell it for 80 cents on the dollar to whoever wants to buy it. They know they can take their time, they can do an organized sale, they can get the best price they can get because the buyers are lining up for deals. The demand is there and the supply is very limited.
But obviously picking up on what Dan and Jeff are saying, well, we're going to see perhaps a deceleration or perhaps more organised sales.
I wouldn't say there is a lot of acceleration. I think there are established processes in various countries. So Ireland is dealing with its bank situation with NAMA, and they have been active, as you said. They have recently sold a 1 billion portfolio. Sareb in Spain is also organizing its process. And they have been able to weather the worst of the recession and of the euro crisis, and now they're able to sell portfolios either of loans or properties, depending on what the individual situations, at much more attractive values from their standpoint. We have had and we have done a number of transactions with banks over the last 3 years in Europe. In some cases, in one-off major transactions with the bank on, and it was not on distressed assets that were very large assets using a lot of funds and requiring a lot of asset management, and the bank was not equipped to do it. It was not an opportunistic deal as such, but it's a strong value at play on which we are taking a long-term view, and the deal is going to generate in the long term very sustainable returns for our investors. It's not going to be a 20% IRR that is underwritten by certain of the opportunistic funds. We have also acquired a lot of performing loans from banks during the euro crisis, and for our debt investors that has also been a very attractive play because they have gained a lot on those loans. Again, very strong performing, high quality loans. And in a way, the banks have sold during the euro crisis some of their best assets because that were where they would make the smallest loss, and they couldn't afford large losses.
Jeff, just to bring up, are the banks doing sale leasebacks in Europe? Are they going to start bringing that back into play?
I think at the moment we're not going to see a huge influx of new bank sale leasebacks being done. I think there were banks that took advantage of the pricing pre-crisis and did some really great deals, some very large deals at very low yields before 2008. There were banks that came to the market during the crisis to do some large sale leasebacks of their big portfolios. The ideas of banks to commit right now to long-term leasing agreements, I think there's too much uncertainty for the banking sector. If you're the CEO of a large bank, to do €1 billion 10, 15, 20-year leasing agreement is a huge commitment. And what to do with that money and where that money goes and what assets to use, what assets to keep, these are all kind of unknown questions for the banking sector.
Where are you seeing some of the greatest risk-adjusted returns when you look at Europe in terms of investing and buying? Where are you seeing some of the best opportunities at the moment?
Today we are seeing opportunities in the value-add space. We are very positive about some secondary assets in the core European countries, so in the UK, in France, Germany, the Nordics, and we are also positive on some of the peripheral countries where where the economy is gradually recovering and where we believe we can achieve value-add returns. Of course, there is more capital, so we are very conscious about competition, but there are still a lot of assets where a lot of work needs to be done because there hasn't been much capital put on those assets for many years.
I think capital will continue to chase yield out into secondary. My favorite places in Europe right now are kind of secondary in the core countries. I saw a 9 cap in the Midlands of the UK with good credit, decent vintage property. I mean, you can't get that type of deal in the US right now. And then I like prime assets in the gateway cities of the periphery countries as well, or the capital cities.
And Jeff, is WP Carey much more looking towards the peripheries away from perhaps some of the prime markets?
We are chasing yield, and so unfortunately, core locations, prime markets, the yield is not there for us. As an income investor, we don't find the yield to be there. I think we see huge opportunities still in Eastern Europe. I think there are some countries in Eastern Europe that have the benefit of a slight premium to Western Europe, along with the enthusiasm on the financing side. So for example, in Poland, you can get slightly better yields than you can get in the rest of Europe, and the German investors the German lenders actually are very active lending into Poland. So you get the benefit of very low cost financing with a slight premium on the yield, and that's kind of a good combination for us as an income investor.